Welcome to LeonCo. On today's topic of the video, we want to talk about, it's a little more casual, not very stiff or professional like our other videos, because we want to talk about a topic that for most of us is maybe something that we have a lot of misinformation, maybe we don't know very well how it works. So we wanted to make this video to answer a few questions, or maybe you learn things that you didn't know about the topic. So on today's topic, we want to talk about the truth of student loans. So we want to talk about three truths. So the first truth that we want to talk about is there's this misconception about if we get a disease or aren't able to work, maybe a passing, and if we have the student loan, what happens to the student loan? So it depends on what type of student loan you have. If you have a federal student loan, or you have a private banking or whatever entity, you have a student loan. If you have a federal student loan, if you get deceased that aren't able to work, or if you happen to pass away, the student loan is completely absolved and you don't have to pay, or anyone in your family, your children, your spouse doesn't have to pay anything about that student loan. But in the other hand, if you have a private student loan with a bank, or you had a co-op with your parents or something like that, they are obligated to pay that student loan. So in the moment when you have to decide which type of loan do you want to take, you should take into account this, because you will be, if you take a federal student loan, you won't put in risk anyone. But if you take a private student loan, or you have a co-dependent in that loan, they will be in jeopardy in the moment that you pass away or something happens to you. They will be responsible to keep doing those payments, or to have that payment for that student loan. So that is a misconception, and that you should know that in the moment that you take a student loan for the type of loan that you want to take, because you don't put necessarily the only person responsible is yourself. But if you have a wife, maybe your parents, or maybe if you have a child, you could put their future financial in jeopardy at the moment if something happens to you. So the second truth that we want to talk about is the main difference between a student loan, a credit card, or a mortgage is that a credit card, a mortgage, or any other type of loan builds interest monthly. Well, student loans, on the other hand, build interest daily. That's right, daily, not monthly like other loans or other debt. So that's why a lot of people in the US or in any part of the world that get student loans have so much trouble to pay off their student loans, because they don't have a fixed interest rate, or they know monthly they're going to pay an exact amount, because student loans generate interest daily. So for example, if you pay your student loan every 30 days, every 40 days, you'll have interest for every day that's passed since your last payment. On the other hand, on a regular loan or a regular mortgage, you just have a fixed rate for interest and for your principal. Not necessarily for your student loan, because the interest payment will depend on the amount of time that you use for your last payment to your next payment. So another tip that I want to give you on this point is the minimum for payment of a student loan is $50. For a federal student loan is $50. For example, if you take out a $10,000 student loan on a 5.5 interest rate, and you're paying every 30 days and the minimum that it's $50, you're actually paying about 45 or 44 on interest and just $6 to your principal. So you basically won't be paying nothing of your student loan. And that's the trick. That's how banks, how the federal government gets a lot of money on this. And this is why there's a big amount of debt about student loans, because since the interest is daily, you pack up all that interest, and all the payments that you make are mostly built up to pay that interest and not necessarily to pay the principal of the debt of your interest loan. So the third truth I want to share with you guys is that student loans generate interest daily, as I told you earlier. But if you don't pay that interest, if you stop paying your student loans, that interest will turn into your principal. Meaning, if you took out a $5,000 loan, a $7,000 loan, and you stopped paying for it, maybe 1 year, 2 years, all of that generated interest will turn into the principal. So you would have that $5,000 or $7,000 loan accumulated with all that interest. Maybe it could be $5,000 more, $10,000 more, depending on the rate and interest generated. So instead of you just paying that $7,000 principal, you'll be actually paying like $15,000 or $20,000 in interest if you stop paying for it, plus the generated interest that you would receive daily from that payment. So this is some of the misinformation or things that they don't share with us, young people or regular people at all at the moment that we want to take a student loan. So I hope this video results helpful for you guys, for the people that are about to start studying, maybe a person that wants to start getting a better education, and you want to see if a student loan is helpful for you. So let us know in the comments if this video was helpful for you guys. Leave us a like, subscribe. Let us know what other topics you want us to discuss. So thank you for checking out our channel here on LeonCo, and always remember to have that king mentality.